$6.6 trillion. You heard that right. That's how much money changes hands every single day in the Forex market. It's kind of mind-boggling when you think about it. And as if juggling that kind of volume wasn't enough, imagine throwing in a curveball the size of, say, a surprise election result. Or maybe like a major natural disaster. Because the Forex market, well, it doesn't just react to these global events. It practically has a sixth sense for them.
It's true what you said about the Forex market. It really is incredibly sensitive to anything that even hints at global instability. But you know that sensitivity, as wild as it can seem sometimes, is actually rooted in some pretty logical connections between geopolitics and how currencies are valued.
Okay, I'm intrigued, so let's unpack that a bit. Our deep dive today takes us into the world of geopolitics and Forex. We're using this DB Investing article as our guide. Specifically, we're going to be looking at how major global events, and I mean everything from those elections to pandemics, can send shockwaves through currency exchange rates. The kind of stuff that makes you want to check your investment portfolio and maybe hide under a blanket for a bit.
And that's exactly why we're doing this deep dive today. Because once you understand the mechanics behind all the madness, you'll be way better equipped to navigate those choppy Forex waters. And who knows, you might even spot some opportunities amidst the volatility.
I like the way you think. This DB Investing article refers to these global events as geopolitics. And I'll admit, that always sounded a bit like a dusty old textbook term to me.
It does have a certain academic ring to it, doesn't it? But believe me, it's actually a pretty simple concept at its core. Geopolitics is simply anything that affects the world's political landscape. And of course, by extension, it's economic stability. And the Forex market, being the global trading hub that it is, it's like this giant, hypersensitive barometer for all things geopolitical.
So it's not just about wars and treaties, then?
Not at all. Remember that viral video a few years back? The one that practically tanked that company's stock overnight? Yeah, that one? Well, that's geopolitics in action. The speed at which information, and I guess more importantly, reactions to that information can ripple through global markets is astounding. These traders are glued to their screens, constantly analyzing every piece of news and every event, and even just rumors, unsubstantiated rumors, can trigger massive shifts in currency value.
Brexit definitely comes to mind. I remember watching the British pound go on a bit of a roller coaster ride during that whole saga.
Textbook example.
Yeah.
And all that volatility just highlights a really crucial point: understanding the various ways geopolitics can impact Forex. That's the key to not getting completely steamrolled when the market throws a tantrum, which, let's be honest, it tends to do from time to time.
Understatement of the year. So before we descend into complete panic, this DB Investing article does a great job of breaking down how these global curveballs actually hit the Forex market. They've identified 4 main areas of impact, and I think they did a good job here. First up, political stability, or rather the lack thereof. Seems pretty self-explanatory, I guess. But I'm sure there's more to it than meets the eye.
Absolutely. Let's just say hypothetically, there's a surprise election result, right? Now, on the surface, just a change in leadership might not seem like a big deal. But it's the context that matters in geopolitics, you see.
Sure.
So is this election in a country with a history of peaceful transitions of power, or one where elections are often followed by unrest and uncertainty? Because the Forex market will react very differently depending on those nuances.
Right, because it's all about investor confidence, or in some cases, the lack of it. I mean, if people are worried about their money being safe in a particular country, they're going to pull out, which of course sends the currency plummeting. It makes sense when you look at it that way.
Exactly. And it's not just about those really dramatic events like coups or revolutions. Even something like escalating social unrest, especially if it hints at some underlying instability. Well, that can make investors nervous and trigger a Forex response.
It's like the Forex market has a PhD in reading between the lines of global news. Okay, so that's political stability check. What's the next big geopolitical lever that can send currencies on a wild ride?
Trade policies. Think of it as the world of international deal-making, where countries are constantly negotiating agreements on what goods and services they'll exchange with each other. Now, imagine those deals start to crumble, maybe due to political disagreements or sanctions, or even just the threat of sanctions. Well, the Forex market pays very close attention to those dynamics.
Like that trade war between the U.S. and China a few years back. All those tariffs being thrown around must cause some serious ripples in the Forex market.
Absolutely. Tariffs, sanctions, import quotas, you name it. Anything that disrupts the flow of goods and services, well, that can impact a country's economic outlook, and by extension, the perceived value of its currency. Remember, Forex traders are always looking ahead, trying to anticipate how these policy shifts might impact future trade relationships.
It's like a giant game of chess, only with real money and real-world consequences at stake. Speaking of things that make my head spin a little, let's move on to impact number 3, interest rates. The DB investing article seemed to think these were a pretty big deal in Forex world, but I'll be honest, I've always struggled to wrap my head around why that is.
Oh, they're definitely a big deal, no question about it. And honestly, they tie into a lot of what we've already discussed. Think of interest rates as like the price of money in a country. When a central bank raises interest rates, it generally makes that country's currency more attractive to foreign investors.
Because they stand to earn higher returns on their investments.
Exactly. And that increased demand pushes the currency's value up. But on the flip side, if a central bank lowers interest rates, well, it can make the currency less appealing, leading to a potential decline in value. And here's where geopolitics comes back in. The decisions central banks make about interest rates. Well, those decisions are often influenced by what's happening in the world around them.
So if a country is experiencing economic uncertainty due to, say, a natural disaster or a sudden political crisis, its central bank might adjust interest rates to try and stabilize things.
Precisely. They might lower rates to stimulate the economy, to get things moving again. Or they might raise them to combat inflation, to cool things down. And either way, those decisions will ripple out into the Forex market. They end up influencing how traders value that country's currency. It's all interconnected.
It's like this fascinating and slightly terrifying web of cause and effect. Okay, we've covered political instability, trade wars, and the enigmatic world of interest rates. What's the final piece of this geopolitical puzzle that can send the Forex market into a frenzy?
Well, it's perhaps the most self-fulfilling one of all. Currency fluctuations themselves.
Okay, now that does sound a bit like a chicken or the egg situation. Which came first, the volatile market or the event that triggered it?
It's a bit of both, actually. Imagine a major geopolitical event unfolds. Maybe there's an attempted assassination of a world leader, or a surprise election result that throws a country's political future into question. Whatever it is, this event triggers some initial volatility in the Forex market. Some currencies might surge as investors seek safe havens, while others might plummet due to uncertainty.
Makes sense. So how does this initial volatility turn into a self-fulfilling prophecy? Well, those initial swings in currency value often make traders even more reactive. Suddenly, everyone's trying to interpret the event's long-term impact, assess the risk, and adjust their positions accordingly.
Yeah, it kind of becomes a chain reaction. One trader's move, especially if it's a large one, can influence the decisions of countless others, creating a sort of ripple effect. And that ripple effect just amplifies the initial volatility. It's like a massive flock of birds suddenly changing direction all at once. You might not know what spooked them in the first place, but you definitely don't want to be the bird that's left flying solo.
That's a great analogy. I can practically see it now. So just to recap, we've got these 4 major forces at play. Political stability, or the lack of it. Trade policies, those interest rates we talked about, and the self-fulfilling prophecy of market volatility itself. And they're all interacting in this complex dance that dictates how currencies are valued on the global stage. It's a lot to process, even for seasoned investors, I'd imagine.
It is, no doubt. And that's why, so many people find the Forex market a little intimidating. It's this constantly shifting landscape, influenced by a million different factors, many of them completely outside of anyone's control. But here's the good news. You don't need to be a master geopolitical strategist or anything to navigate it successfully.
Okay, that's reassuring to hear. Because right now, I'm feeling a bit like I should be brushing up on my risk assessment models and maybe investing in a really good stress ball while I'm at it. But seriously, where do we even begin to get a handle on all this?
Well, you're in luck. Because this DB investing article we've been talking about, it actually offers some really practical strategies for dealing with Forex volatility. And they're all about empowering yourself with knowledge, and a good dose of perspective, which never hurts.
Sounds like a good place to start to me. What's step 1?
It might sound obvious, but it's amazing how often people overlook it. Stay informed. Don't just skim the headlines and react emotionally to whatever catches your eye. Take some time to dig deeper into what's actually happening in the world, especially those events that could have economic ramifications down the line. And even more importantly, try to think critically and analyze the potential impact those events might have.
So you're saying it's not enough to just read the news. You have to think about what the news means in a broader context.
Exactly. And that means being discerning about where you get your information from, finding reliable sources, whether it's in-depth financial news outlets, economic analysis reports, or even, dare I say, reputable podcasts like this one.
Well, we do try our best. And speaking of DB investing, it looks like they have a whole section on their website dedicated to economic news and analysis, plus live webinars, even their own podcast. They seem to be taking this whole stay informed thing pretty seriously.
They do, which is a good sign, if you ask me. But that we were talking about those strategies for navigating Forex volatility. Once you've got that solid understanding of the global landscape, we can move on to step 2, diversification.
Ah, yes, the age-old wisdom of not putting all your eggs in one basket.
I'm guessing that applies to currencies just as much as it does to anything else, right?
It absolutely does. In Forex, diversification basically means spreading your investments across different currencies, even ones that might seem less sexy or high growth at first glance. So if one currency takes a hit, maybe because its country is going through a political upheaval or a trade war, the others can help cushion the blow a bit.
Precisely. And one of the best things about Forex is that there are so many currency pairs to choose from. You can diversify across different regions, economic blocks, even currencies with historically inverse relationships.
Inverse relationships. Now that sounds intriguing.
It's a fascinating aspect of Forex, so we could definitely delve into that a bit later if we have time. But for now, just remember that diversification isn't just about spreading your risk. It's also about potentially capitalizing on opportunities that arise when certain currencies move in opposite directions.
Okay, so we've got staying informed, we've got diversification. What else is in this Forex survival toolkit of yours?
This next one tends to be where people either get really excited or really intimidated. We're talking about technical analysis.
Oh, I'm familiar with this one. Charts, graphs, algorithms. It's basically like learning a whole new language, isn't it?
It can seem that way at first, you're not wrong. But honestly, you don't need to be a math whiz to grasp the basics. Essentially, technical analysis is about looking for patterns and signals within historical price data. And we use those patterns to try and predict future market movements.
So you're saying that hidden within all those squiggly lines on a price chart, there are actual clues about where a currency might be headed next.
You got it. Now, it's important to remember that technical analysis isn't foolproof. We're not talking about predicting the future with 100% certainty here, but what it can do is provide you with an additional layer of insight, a way to read the market's sentiment and potentially make more informed trading decisions.
Okay, so let's say I'm looking at a chart for a particular currency pair, and I notice a pattern. Maybe the price has been bouncing between two specific points for a while now, forming what traders call a range. What does that tell me?
That's a great example. A range-bound pattern like that can indicate a period of consolidation, where neither buyers nor sellers are really able to gain a clear advantage. It might suggest that traders are waiting for a catalyst, maybe an economic announcement or a geopolitical development of some kind, something to push the currency in one direction or another.
So, if I understand correctly, armed with that knowledge, a trader could set up trades to capitalize on those price swings within the range, or even place orders to enter the market once the price breaks out of that range, in either direction.
Exactly. Of course, there are tons of other patterns and indicators that technical analysts use, each with its own nuances and interpretations. But the point is that by studying historical price data, you can begin to understand the forces at play and make more educated guesses about where a currency might be headed.
Educated guesses are definitely preferable to blind faith when it comes to something as dynamic as Forex, that's for sure. But even with the best analysis and strategies in place, there's always the chance that a trade won't go your way. And in the Forex world, those wrong turns can get expensive pretty quickly. Which brings us to the final, and let's be honest, probably the most crucial tool in our Forex survival kit. We're talking about stop-loss orders. It's like that safety net you hope you never need, but you're eternally grateful for when you do need it, right?
That's a great way to put it. A stop-loss order is basically an instruction you give your trading platform. It's set up to automatically sell a currency pair if it reaches a certain price level that you've predetermined.
So let's say I'm feeling bullish about the European economy, and I decide to buy a certain amount of euros. But then, completely out of left field, some unforeseen geopolitical event sends the euro plummeting. In that situation, a stop-loss order would automatically sell my euros before the losses could snowball, right?
Exactly. It's like you're setting a financial safety net for yourself. It's there to prevent those emotionally charged knee-jerk reactions that can sometimes lead to even bigger losses.
Yeah.
You're essentially saying, okay, if I'm wrong about this trade and the market decides to move against me, I'm willing to accept this much loss, but no more.
That sounds like a pretty powerful tool for managing risk, especially in a market as unpredictable and volatile as Forex. It's almost like having a guardian angel looking out for your investments.
It's about as close as you're going to get in the world of finance. And, one of the great things about stop-loss orders is that they really do take the emotion out of trading. You're not scrambling to react in the heat of the moment, trying to make rational decisions when everything feels chaotic. The decision's already been made. It's pre-programmed into your trading platform. It's really about protecting yourself from those worst-case scenarios, those moments where you don't want to think straight.
Which, let's be honest, are always lurking around the corner in the Forex market, wouldn't you say?
I'd say that's a pretty fair assessment.
Well, I think we've covered a lot of ground here today. From understanding all those intricate ways geopolitics can influence currency valuations, to equipping ourselves with some really solid strategies for navigating those, shall we say, choppy waters.
We have. And I think if listeners take away one key thing from our conversation today, it should be that while the Forex market might seem intimidating at first glance, it's far from insurmountable. With a solid understanding of the forces at play, a commitment to staying informed, and a healthy dose of risk management, well, it's a market that offers incredible opportunities.
It's almost like we've been given this backstage pass to this exclusive global club, the one where trillions of dollars change hands every day. We might not be seasoned members just yet, but hey, at least now we know the dress code and a few of the secret handshakes.
Exactly. And don't forget, every fluctuation in the Forex market, every dip and surge in currency value, it's telling a story.
Yeah.
A story about the world we live in. It's a fascinating, ever-evolving tapestry woven from global events, economic trends, and even just basic human psychology.
It's like a real-time economic thriller playing out right before our eyes, with currencies as the main characters.
Now, that's a great way to put it. And who knows what twists and turns await us in the next chapter, right?
That's the truth. Well, on that note, I think we've successfully navigated this thrilling and occasionally turbulent world of geopolitics and Forex for one episode. A huge thank you to DB Investing for providing such an insightful roadmap for our deep dive today, and to you, dear listener, for joining us on this journey.
It's been my pleasure as always. And to our listeners, until next time, remember, knowledge, diversification, and a well-placed stop-loss order, those are your best allies in the exciting world of Forex trading.
Words to live by. Happy investing, everyone.